Welcome to Season 2 of the Generational Dental Wealth Show. Season 2 is all about increasing dental financial IQ. We do record these live in studio at Team Studios, so if you want to see the video format of this show, go ahead to Spotify or YouTube. What's up, Dental Wealth community? So, today's episode is a very special one. I want to bring you into a great conversation I had with the Truth Be Told podcast with Dr. Leroy Horton and Dr. Walter Aka. Man, I really think you'll get great value out of this episode here. We talked all things taxes, making sure you have what you need as a dental professional. So go ahead and tune in. Like I said, it's going to be an exciting one. I'll see you on the other side.
Hello. This is Truth Be Told. This is Dr. Walter Aka.
All right, this is Leroy Horton.
This is Kingsley Affetti.
Oh, man. So we are so honored and blessed to have Kingsley on today. When you're a dentist, you know a lot about dentistry, but very little about how to manage offices, how to basically manage money, and right now we were just talking offline here that, generational wealth has become a buzzword. Everybody's talking about generational wealth when it comes to real estate, when it comes to investing and stuff like that. And I think the one thing that I know is I can't live without my accountant. I actually just emailed him today. I said, hey, I'm getting all these taxes, property tax. I'm getting taxes for this. And what do I need to write off from my business? What do I need to write off for that? Like anytime I have a question that is going to prevent me from getting in trouble with the IRS, that's the person I contact. So I contact him a lot. And it just happens that he's also a family friend. So that helps, So,
can we first start by saying how dope it is that we got two brothers out there killing the game, and not just brothers as in melanated brothers, but brothers. Because we just talked to your brother, and now we got you on a week later. And I just want to applaud both of you for the work that you're doing, and the example in the community that you guys are setting. And so, yeah, I mean, we can get back to the question. I just want to give those roses and those flowers out there right off the bat.
That's
yes,
it.
Sir.
That's
well
it.
Received. Well received. Yes, sir.
And they're both on there together, working hard, doing their podcast. They're doing a lot. So when I say that this man is, it was a pleasure to try to get him on, I mean that. Like, it was tough. He's a busy guy. But he made time for us tonight. So let's not waste his time. Let's just go ahead and dive in. And Kingsley, can you please just kind of introduce yourself and how you became affiliated with being a dental CPA?
Yeah. So, like I said, my name is Kingsley Affetti. I'm a dental CPA located here in Charlotte, North Carolina. Pretty much, the path to, I would say, first becoming a CPA, then get into the dentistry side of things. Obviously CPAs typically go to school, do undergrad. Typically, a lot of CPAs go and get the master's. So I went ahead and got my master's in accountancy, which really got the ball rolling. After that, I obviously went in and sat with the board to go ahead and get that CPA. But I always knew I wanted to be around not just the everyday tax type of CPA, but I wanted to build relationships. So my brother that was on last episode, Dr. Jermaine Fetty, when he opened his practice here in Charlotte, Empire Dental Group, he said, "Hey Kingsley, I want to make sure that you are one of the first key founders of what we have going on here." And I was actually his first office manager. So pretty much from, insurance verifications, checking patients in, doing all of the consent forms, et cetera, even to a point, right? Looking over treatment plans, looking at the financials, really gave me a really deep insight on the world of dentistry. And really just saw the way that money moves around a dental office and a dental practice. So pretty much, like I said, I wanted to blend the financial CPA background with the practice and the healthcare part, the psychology of money, the psychology of patients, and just pretty much blend it all together to pretty much help dental professionals maximize their profession.
Okay, now tell me, because it's a little bit nuanced, right? What is the difference between what most offices will have, which is a bookkeeper,
exactly,
and then a CPA that comes in maybe quarterly to kind of tighten up the financials and do the taxes at the end of the year? What's the difference between a bookkeeper and an actual CPA?
Yeah, great question. So bookkeeper is legit going to just keep your books. So your books, and you can call it any fancy thing you want, is typically keeping your accounting records. So basically, every time you go to the bank, you swipe your card as a business owner or 1099 practice owner. You need to keep records because every year you need to be able to have a profit and loss and a balance sheet. What that's going to do is help you during tax time. But what me and what I believe as a dental CPA is your profit and loss statement, right? That's telling you what money came in and what money came out, right? Your balance sheet is telling you what you own, right? Assets, what you owe, liabilities, whatever's left over is equity. I don't believe that should just be a tax time conversation. I believe that should drive your decision making as a practice owner, because it's kind of like driving a car at night without headlights. You can do it, but you're kind of driving blind. You don't know what your collections are. You don't know what you don't know what you're producing versus what you're collecting on. I mean, you can have $1 million practice in production, but only collecting on 700,000. That's $300,000 that you think you need to do more marketing, but you just need to get better at collecting money, right? So the financials are there to help you kind of navigate the day to day, not just, okay, during tax time, I need to give this to my CPA. So long story short, biggest difference between a bookkeeper and a CPA, bookkeeper is just going to be giving you the monthly profit and loss and a monthly balance sheet. They're typically not going to be giving you, any tax advice, any legal advice. They're typically not going to be the ones to build the long-term, I would say, holistic relationship. I would maybe compare it to maybe a hygienist versus, the doctor that comes in, right? They both have a part in the overall oral health, but, the functions are slightly different there.
Okay. What I want to do is I want to just kind of do a chronologic order of importance and basically how would we use your service as we matriculate through from dental school all the way through practice ownership. So let's just start as a dental student, right? We have a lot of debt. We barely make any money to live off of. Like the school will give you something, aka your loans will pay you to live off of that, right? Yep. Why would anybody or would a dental student need a CPA?
Yeah, so my rule of thumb is, obviously early on in your career versus later on in your career, you'll need certain things financially. But my rule of thumb is, you're, as a D4, living on ramen noodles half the time, right? Typically going out with the bros, with the gals, hanging out. But just in a few weeks, your income jumps and your tax brackets jump overnight. So it's one of those things where, yeah, you could continue to TurboTax your way through it, but you go from, maybe coming from a background or family that didn't really have much to now you're making, 150, 180, $200,000. You do want somebody to kind of look over your shoulders, even if you do TurboTax it. What I would say typically with dental students, not just having a CPA just from the standpoint of filing taxes, even if you file your taxes, having a CPA review your taxes, because the more income you get, the more tax brackets you jump, the more likely you are for IRS audits. And we all know taxes, just like anything, is very tricky, right? Everybody probably is missed a decimal or done something, right? At the end of the day, you still want a CPA looking over your shoulder to make sure you're doing things right, because now you're getting into much, I would say, muddy waters, because you're no longer a student, right? You're a professional that's making a real living for yourself.
So even if it's like just a W-2, no dependencies or anything at all, you'd still would say, hey, have a tax expert evaluate your income.
Yeah, so I would say to your point, kind of a two-pronged approach. Number one, yes, have a tax professional review it. Reason being, there could be credits and deductions that you're already missing as a W-2, right? I mean, we all know how the tax some of us may know how the tax brackets work, right? The more money you make, the more percentage you pay on that same income. So you don't want to miss out on credits and deductions, because you're already in a high tax bracket. So we do want to make sure that you have somebody looking over you, because you don't want to end up, overpaying in that. Now, the second prong approach, like I was saying before, is at the end of the day, now that you have disposable income, and we're not going to get in, I wouldn't go get into this too much tonight, but you have more disposable income to invest, right? There may be investments that are tax advantaged to be able to even offset some of your W-2 income, that now you could be getting some of the money that they already took out of your taxes back during tax time, because you have a CPA saying, hey, you have $100,000 cash now. Instead of shoveling $100,000 into your student loans, let's go ahead and put $60,000 of that towards some type of asset, property, or something like that. See how we can reduce your W-2 income. Do some different things like that.
Okay, so if I'm hearing you correct, you do want to start seeing these, young students, soon to be graduates, early. how does that relationship form or start? Do they come to you and say, hey, I'm about to graduate, and you do a consultation and you kind of stay with them, and then you do an official charged service? Or at what point is the relationship transactional in the traditional manner of they're going to have to start paying you for your advice?
Yeah, I got you. So pretty much what I would say with any good CPA, just baseline, this is not unique to me. You know, whenever you do visit that CPA once a year during tax time, that gives that CPA now a chance to look a little bit deeper. And what I mean by that is typically your CPA is going to have a very close relationship as you progress as a dental professional. So even if it's just that one time a year, now next year is 2 times a year, and then the year after that, right now you're thinking about, okay, I'm starting to get my hand speed. Maybe I want to kind of, dip a little bit in multiple office because maybe I want to do a little bit on the side, 1099. And then you've already built that relationship. You've already built that trust. I always say, a CPA is pretty much as intimate as your doctor, right? We know things about you that even sometimes your spouse does not know.
Right.
So
Right.
You'd be surprised how many people become like, don't tell my wife. I'm like, if y'all filing jointly, this is y'all doing it together. So the earlier you start that relationship, you build that trust, you build that rapport, just like when you've been going to the same doctor for 5 years. It's just a more natural relationship, and you're able to be more honest with that professional.
Yeah. So when do you want them coming to you? Right after they graduate, so you can start guiding and advising them, and then you got them towards tax time? And when's the best time to approach you?
Yeah, I would say right out of school, and the reason being is never too early, especially for those professionals that are not looking to be in W-2 forever. Especially for those. I mean, if you're doing one W-2 a year, typically your financials are pretty straightforward, maybe no dependents, nothing too crazy going on. Maybe you can get by with figuring it out yourself. But for those professionals that's thinking, okay, what can I do? Maybe practice ownership, maybe travel dentistry. Maybe I'm filing joint now. My wife or my spouse has some situations going on. Maybe it's time to start engaging. But I would say, I mean, there's nothing wrong in coming, right out of school, visiting your CPA. Yeah.
So, here's a question so we've gotten out of school, we graduated, thank God, right? And we're making money now. We're all excited, we're happy. We're starting to see the fruits of our labor. You get married, right? You start dating somebody, you're like, okay, they see you, okay, they did well. I waited for them. Now let's get married. We got married. When is it a good idea to file jointly versus when is it not a good idea to file jointly? Is it ever not a good idea to file jointly?
Yeah, so great question. What I always say as a general rule, right? Because when it comes to accounting, anything legal, we have general rules and we have exceptions. General rule is always better to file joint. Reason being, not only do you get a higher something called a standard deduction, which will help decrease your taxes, but when you file separate, the government actually takes away a lot of credits and deductions that if you were to file jointly, meaning the government is essentially trying to encourage people to file jointly. It's nothing illegal with filing separate, right? But they have that as an option for a reason. But they do want to encourage people to do that because, right, the government believes in the family structure. But like I said, they do take away some credits and deductions if you do file separately, and it's a few other things that they do. Now, the situation that I see people filing separately, let's just say that one person has a lot of debt. Maybe they don't want to commingle funds. Maybe there's some type of prenuptial agreement in place. Another one that I see is, maybe they're just not on the same page financially for whatever reason. I always don't recommend it, but I do know that there are cases in which it's necessary, or maybe just financially they just don't want to commingle. So either way, we always handle it, the best case scenario, whatever they want to do.
Yeah.
Okay. So for the public, because I always hear these people getting these terms mixed up. Mm-hmm. I've heard plenty of people say, "Oh, you bought a new CT machine, great! It's a tax write-off. I mean, it was pretty much free, right?" Mm-hmm. Can you give the definition of what a tax credit versus tax deduction is, and maybe some general examples of each of those?
Gotcha. Great question. So tax write-off, tax deduction, business expense, those are all typically going to be used as the same word. All that is the government essentially saying, you as a business owner, and this is typically applying, and right now we're talking more on a business owners. Typically you find some type of business return, 1099 contractor, you get deductions. different tax write-offs. Now, there are some that are available for individuals as well, but let's just talk about the business. It gets a little easier to conceptualize. With a deduction or a business write-off, an expense, typically you go make your income, right? Whatever you go spend, as far as, let's say that you're buying a new machine, you're buying dental equipment, maybe you need to send something off to the lab, right? It's lab fees involved. Whatever you spend now becomes a business write-off, meaning that if you make $100,000, as a dental practice owner, and you go and you spend $60,000 in expenses to run your dental practice, there's $40,000 left over. Now, that $40,000 is the only money that the government's going to tax. Because how can they tax money that you've already spent? Do you know what I mean? So they don't tax you on revenue, right? Or collections, right? That's typically the top line. They tax you on revenue or collections minus expenses and whatever is left over, right? We call profit. That's typically what you'll be getting taxed on. Now, that's what I just explained as a deduction. Now, a credit is slightly different. A credit is dollar for dollar. So typically, what ends up happening is, in the equation that I just gave, right, we have revenue collections minus all the different eligible expenses, write-offs, deductions, whatever you want to call it, equals your profit, right? Now, at this point, that's when credits now come into the play. So credits aren't necessarily, they're not necessarily subtracting your income. They're giving you a dollar for dollar amount towards the tax bill. For instance, right? And this is like giving an accounting level, master's in 30 seconds. But you have your $100,000 of collections. You have your $60,000 in business expenses. You have $40,000 left over. Let's say for whatever reason, you'll say you're in a 10% tax bracket, so you get a 10% tax applied. You have a $4,000 tax bill. Now, at this point, if you have a $5,000 credit, okay, let's think about it. You have $4,000 tax bill, you have a $5,000 credit. Typically, and depending what type of credit, that $1,000 difference that they're crediting to your account can be refunded back to you in a way. Right? Or let's just say it's a $3,000 credit, you might owe $1,000. So it's credit. Right. Exactly. So credits and deductions are slightly, it's a little bit, I guess it could get misconstrued, but for the most part, they have two different functions and they come in two different places of pretty much the whole entire formula.
So okay,
I help. Yeah. Does that help?
Well, no. So I was actually kind of on the same line. You go online, and one thing that we try to do on this podcast is we try to basically squash everybody's hopes and dreams about being an influencer. We we hate that. No, I'm just kidding. But no, you go online and you see a lot of people talking about, oh, if you get a G-Wagon, you can write off this and do all that. Can you explain to us and just finally put that to rest, like how that whole I think, what is it? Is it 60K or 60,000 and weight and all? Can you explain all that so that people stop listening to these influencers and start listening to the professionals? Explain that whole credit and all that stuff when it comes to the G-Wagon and all these, write-offs in that way.
Gotcha. So I'm going to use, I'm not on the clinical side, but I'm going to try to use a clinical joke. It's like the equivalent of thinking that veneers will solve your oral health. It's like fixing the look of it, but it's still underlying the disease and all of this.
Okay.
So meaning what I'm trying to say with that is everything that when it comes to taxes and all these things you see online, are they illegal? Are they wrong? Typically not, but they will apply to certain circumstances. There's literally no legal or tax advice that anybody can give that will apply to you, apply to me, apply to the dental student that's coming out a year one. It's all circumstantial. And that's why us accountants, we always have a joke that it always depends because it's reality. Now, as far as the vehicle, purchasing a vehicle, where that came about was back in 2017, Tax Cuts and Jobs Act, Donald Trump, right? We all know him, introduced this tax bill that was really favorable to business owners. His belief was, if we encourage business owners to spend more, to do more, right, the economy will grow. So there was a caveat, something called bonus depreciation, in which what they said was certain vehicles over 6,000 pounds, you'd be able to expense the whole entire vehicle in year one. So the thing about when you buy any type of asset, whether that's a building, whether that's a car, that CBCT machine, whatever it is, you can't expense it all in year one. Meaning if you make $100,000, right? And let's just say that CBC machine costs $80,000. If you let me use a better example. Let's say you make $100,000, right? And you have the CBC team CBC team get my words mixed up.
Yeah, CBCT, yeah.
that costs $50,000.
Right.
Typically depreciate equipment over 5 years. So meaning each year from today, from the first year to the 5th year, you take a $10,000 tax deduction for the next 5 years. That's called depreciation, right? That's the bare bones basics, meaning each year you legally have to take $10,000 for the next 5 years. What the Tax Cuts and Jobs Act effectively did was decrease the lifespan in which you can depreciate it. And they said, instead of you waiting 5 years and you taking a $10,000 deduction each year, right, we're going to let you take the whole $50,000 deduction this year, which effectively help people decrease their taxes quickly. Now it may not seem like that big of a deal. I mean, but when you think about, buying a $100,000 vehicle and you have $100,000 worth of income, that's the difference between you, if you spread it over 5 years, that's the difference between your profit being, say 5 divided by 100, 20, that's the difference between your profit being 80,000 and your profit being zero. Meaning if your profit is zero, you pay $0 in tax that year. If your profit is 80,000, you're still paying a buttload of taxes, right? So that really helped, I guess, spur economic growth. But with everything, right, it all depending on your specific situations and circumstances. Yeah.
Right. But let me ask you this, because a lot of those things get announced, and how can a dentist that owns a dental office justify that a G-Wagon is a work vehicle?
How dare you? I justify that every day.
well, okay. I'll say this.
I'm kidding.
When it comes to any write-off, right? There's typically two tests. Is it ordinary and is it necessary? How I like to define it, is it ordinary? Meaning in your trade, in your business, is it ordinary to have a vehicle? Yes. When you're running a dental practice, you have to drive to work. I mean, you can't, nobody's riding a horseback. And is it necessary? If I had 5 G-Wagons, probably not necessary. If I had 1 G-Wagon, we can argue why that's necessary, right? You as a dentist, right? You're typically going to visit, maybe other practice owners. Maybe you're doing different deals. You don't want to ride in a Nissan, right? And there's no knock to Nissans.
Whoa! How dare you? Whoa!
No knock to the Nissans out there, but you want to be able to put on a good presentation. Now, with anything when it comes to the tax side, the IRS always try to distinguish between what is business and what is personal. Meaning you might not be able to write off the whole G-Wagon because only 50% of it is used for going to the practice, going to Costco's to pick up supplies, doing this and doing that. It might only be used 50%. So I guess to your point, right, it is kind of difficult to justify why you need it 100% for business, but we have some ratios that we like to kind of talk about when it comes to that.
Right. And the only reason I ask is, because when you grow up in certain areas, there's a lot of hustlers, right?
Yeah.
Everybody starts a business and all of a sudden they write off everything. Every time you go out to eat, let me get your receipts. I'm going to write these off, right? So there's a lot of people that could potentially get themselves in trouble if they ever get audited because you do have to justify your purchases, as you said, as being ordinary and necessary.
Sure.
Do you or have you seen people kind of fall into those traps of maybe getting a bad advice from the wrong people and kind of going ham on some of these practices?
Well, I know we experience it in the accounting world. I'm sure you experience it in the dentistry world. Everybody wants veneers, right? Nobody wants to really, I want to see how I can do the work. Let me just, so obviously with the TikTok culture, with the social media culture, there's a lot of information out there that's just not always accurate. But to your point, I will probably divide that into 2 different answers there. The first one being, a lot of times when it comes to writing everything off, what ends up happening is when you're going for financing, you're trying to purchase that vehicle, you're trying to purchase that house. Maybe, you're a dental practice, or excuse me, a dental professional. Maybe you're looking to buy a practice. All of these different institutions are going to want to look at the tax returns, and if you're saying that you made $150,000 last year, but you wrote off 160, or even if you know what I mean, it's just, right. They're looking at the bottom line. They don't care how much you brought in. They care about how much you have to pretty much live your life on, right? That bottom line. So long story short, yeah, you can play the game and try to figure out how you can wiggle around and do all of this stuff. But at the end of the day, when it comes to you trying to progress, get financing, move up to the next level in your career, you're going to be stifled. And that happens so many times, especially when it comes to home ownership, because that's always what they want. They want last 2 years of tax returns, always.
Right.
And then number two, right? And all of this is with the assumption that it is already ordinary and necessary. Is what we're already kind of getting to that. Yeah. Yeah.
So here's another thing too, that a lot of people kind of ask questions about. I just got a job, right? So I got out, I got a job, I'm so happy. I'm a dentist, right? I can put the doctor in my name and I'm excited about life. And the owner comes to me and says, well, how would you like to do this? Would you like to be a W-2 or a 1099?
Yep.
Which one is better? And which one is more beneficial from a tax point of view?
And you can't say depends.
And you, you have to give us something.
Well, okay. What I would say is, when we first start dealing with a client, we always just try to assess what type of client this is. Are they risk adverse? Do they love stability? What is their risk tolerance? What type of lifestyle do they want to create? And then it goes back to what you just said. It depends from there. But the long story short, the biggest thing about it is just understanding the pros and cons of each. Then you make your decision based off of what do you like at a life? Do you like comfort? Do you mind being uncomfortable? Let's just start with the W-2 because that's the easiest to understand. We've all worked summer jobs. We've all been on the W-2 employee side. So as a W-2 employee, and really before I even get down to differences, the biggest difference when it comes to taxes is the order in which you are taxed, which changes a lot. So as a W-2 employee, we all know before you get that check, especially when it was your first job, before you ever got that check, you're thinking, you're calculating what you're about to go buy tomorrow. You calculate when you're about to go with your boo thing. You're like, yo, I did X amount of hours. I should be paid $1,000 his paycheck. And then you get it and it says 700. And you're like, what just happened? I mean, somebody must have calculated something wrong. But we all know those big 4 letters FICA, right? Typically insurance, typically Social Security, Medicare is already taken out of your taxes. On top of that, federal and state tax withholdings. So when it's all said and done, that $1,000 check that you're getting, you might only see 700 of it. And then at that point, that's the money that you go take and you go live your life. You go buy your groceries, you go buy what you need to buy, right? So it's tax first, then you get income, then you go spend money. But as a 1099 or a business owner, right, we group those into the same tax category. Instead, what the IRS says is, wait. Before we tax you, we're going to change the order a little bit. We're going to let you go get your income first. So we're not going to tax you first. We're going to let you make all the income that you make for the year. Then we're going to let you go spend all the money that you can, right? We want to encourage spending. The government, follow the incentives. I'm going to encourage you to go spend as much as you can because that keeps the economy revolving, right? And like I said, ordinary necessary expenses, right? And then whatever is left over, if there's anything left over, then we'll take tax out of that. So long story short, what ends up happening is, as a W-2 employee, you might never see that money. That money is already sent to the IRS before you even get it. As a 1099, you can move things around a little bit more because maybe you say this year, my vehicle is getting kind of old and I have to keep going to the practice every day at 6 a.m. Maybe I need to upgrade, right? And now that becomes partly deductible, right? And it helps you pay less tax. Now, that was kind of just the differences there. We all know typically W-2 employees, you get all the benefits, 401k match, you get sick pay, you get all these different benefits. Typically 1099 contractor, business owner, you're on your own. There's nobody taking any taxes out. There's no benefits typically like that. But on the flip side, especially for those, locum tenens and things like that, you're typically going to get your check in gross amounts, which are going to be bigger amounts. But it's just going to require much more responsibility of you now making sure you're putting enough aside, right? Because you are getting gross amounts, so nobody's taking anything out of your check anymore.
Yep. Well, that was a perfect answer, man.
And that's it for this week's episode. If you want more, tune in next week as we continue the conversation. Go ahead and show my guys, Real Tooth Be Told Podcast, some love. Follow them on Instagram at Real Tooth Be Told. Can't wait to see you next week.